Good afternoon. This is Ken Long from Tortoise Capital with part 2 of our insight into the regression line fractal 4, and now we're going to take a look at what happens when all 4 regression lines have come together and agree on price. And so now we're taking a look at symbol XLF, which has a daily frog box of 0.07, a weekly frog box of 23 cents, monthly frog box of 35 cents. And look at our little forecasting device here. We have XLF. The 10-period regression forecast is 22.67. The 270 period is 22.47. That gives us a 20-cent raw opportunity, which is a 0.88% deviation from that forecast of the 270. With an ATR percentage of 0.77%, that gives us an opportunity ratio of minus 1.14. So in other words, it's only 1.14 ATRs off of the 270 regression line. And so this dotted purple line is the extended. Let's line that up. That's the extension of the 270 if it were to continue at the same slope. And we've got the we have that little one standard deviation plus or minus river on the 270. That's that ribbon or the noise range. The blue is the 10-period regression line. Price is in that orange ribbon. The black is the 30-period regression line, and the green line is the 90-period regression line. So that's our 4. Now, some things to notice about XLF. It doesn't really get that far from the regression line on the march up, but it does have moments at each of these red lines and yellow shaded areas where it reaches a local minimum. In other words, a maximum divergence from the 270 during that moment, and then a sharp reversal. And what we might want to notice is generally a series of rising lows. Not surprising based on the upward slope of the 270. And now let's take a look at price as it approaches the 270 and what it does. Back in September, it got as close as the middle of that noise channel. You might think of that as early warning. It got to the edge of the noise channel here. It touched the 270. It spent some time across the 270, a couple humps, and then failed. And this time it actually made 3 humps over the top. And again with rising lows, and now we've actually got what looks like a strong breakout above those previous 3 humps and the 270, which had almost flattened out, and this is really a 2-year high. And so if we were to draw a channel line between the rising lows and the rising highs, we might get this blue channel. And so now on this breakout with no resistance above, we might ask the question, how far could this thing go? And we might just take a couple different looks. The first one would be the yellow box is as large as the divergences to the downside. So if we think volatility is symmetrical and you just moved from 2250 to 2375, that's how far the excursion on the upside could go based on how far it failed in recent history. We might also simply just extend this channel out and project a test of this upward channel and get a price around 23.25, and then in any case we certainly have a weekly frog box is 23 cents, and so that would take us from a current price of 22.50. We could buy this breakout now. A frog box of a weekly frog box would put us just underneath the regression lines, and that would give us a clear 2-to-1 just to a test of the channel, and then 4 or 5-to-1 if we went all the way to the limit of that favorable excursion here. So in any case, we have reasons to be interested in XLF and to think that the regime has changed, and this looks like a favorable trade. So when we're looking for reversions to the mean, we want to find those things that have the greatest opportunity ratio, either on the plus side or the downside, because that's going to represent the greatest excursion from the 270 already, and then we're planning to move back to the 270. Or in this case, we want to look in the middle of the table and find those that are close to 0, and I can already tell you that XLI with an opportunity ratio of 0.38 is going to be very close to its own 270. The RL10 and the RL270 are both packed together nightly, and that could be poised for a breakout. We can see back here at each one of these divergences, when you minimize the distance between the 10 and the 270, you've set the conditions for the next running of the bulls. In the previous 1, 2, 3, 4, 5, 6, 7, 8, 9 cases, those divergences went to the downside. Now you see the beginning of the first positive divergence to the upside, and that could indicate financials coming back online and having some room to run. All I know is right now, this is a good thing to own. 2-year high, range expansion, reasonable targets above, not all bad. So that's regression line fractal 4, what you do when the regression lines are together and you have a price beginning to break out to the other side of the 270. We would tell you from the inspections from this week at the live workshop out here in Kansas City, which you ought to attend. The downside divergences tend to be deeper, sharper, and more quickly recovering, particularly if the 270 is sloping upward. So keep an eye on those and look for a video on that in the near future. Anyway, keep your powder dry and your risk measured. This is Ken Long at Tortoise Capital. See ya.